G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Alright, let's go. So the topic for this video, we'll be going over some economic data, particularly what the Fed said in this morning's, my time in Australia, FOMC decision, interest rate decision, and going over inflation and jobs market, seeing when they're going to cut rates, and also looking at just going over that recap for that, and also the stock market, the crypto market, how they reacted to the Fed press conference, also some other data to do with earnings, and yeah, just savings rate of the average individual, just to go over what the consumer's feeling in these times, economic uncertainty. And yeah, we'll just start there. So we'll go firstly to the economic data that came out. So we have the last night, 10:30 p.m., we had ADP, employment change. So this is before the unemployment rate, just gives you an idea what's going to happen. And we had previously 155,000 jobs added, and the forecast was 140, and guess what? We came in lower than expected. So not good. I'll show you just a timeline of previously what sort of happened. So it's private businesses in the US, okay, adding workers to their payrolls. So we can see here that we had the highest peak in March, 11,000, going up from 175 and 111. So we had going up. Now we're sort of seeing go down, 188,000 April, 157,000 in May. June, pretty flat. Okay, 155,000. Now we're getting a big drop, 122,000. Okay, so we're having less and less jobs added. And if I show you going back, we start seeing a big decline. I don't know if it's going to be that sharp. That's a black swan event, but when it started to go negative, that's see some really fear in the market, and it's certain the recession is kicking in by then, surely underway by then, but we're still above, still adding jobs, and yeah, still so strong. So the numbers, ADP, and we had the Fed interest rate decision also, which is in red here. It's high impact news, and forecast consensus was 5.5 to stay the same. It was previously the same, and they didn't cut rates. They stayed the same. And you see more data. So that was the reading there. And just going over the recap. And Chair Powell gives September rate cut signal traders were hoping for. So he's very dovish in his remarks, looking over how well they did bring inflation down and how strong the job market is. And so he's very confident that it's coming to the point rate cuts are going to be a reality finally after so long. So they kept it from 5.25 to 5.5, saying that some further progress towards its 2% inflation goal, and a rate cut is on the table, Jerome Powell says. It's a possibility. It's never a certainty, because you can't just say, it's going to happen, because data could change, and obviously it changes their decisions. They just go month to month. It's how they make their moves. So you said that absolutely apolitical if it's lowered borrowing costs at the meeting. So the Fed cautions against assuming that the cut was definitely happening. So he doesn't want to be political, okay? We never use their tools to support or oppose a political party, a politician, or any political outcome, Powell said. He said the central bank's economic forecasts do not take account who wins the presidency. So they don't want to be political. They're making that clear. We'd never try to make policy decisions based on outcome of the election. It hasn't even happened yet, says Powell. Okay, so that's the political talk there. A 50 basis point rate cut next So next meeting in September is unlikely. So I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now. So he doesn't expect a big drop. 50 basis point cut is quite a big drop. So at this stage, 25 basis point cut is priced into the market in September. And yeah, then we have watching really carefully for sharper labour market downturns. So looking at the labour market now. And we're watching really carefully for that, he said in Wednesday's press conference. We're aware of that role, which I would call it a statistical thing that happened throughout history. At this point, low unemployment and a low level of layoffs suggest a normalising labour market, says Fed Chair Powell. All right, your economy looks completely different than a year ago, Powell says. Okay, so Chair Powell says it's a completely different economy, he said a year prior when they were raising rates. Unemployment inched higher with a path of inflation has come down significantly. Powell described the current economy as both historically unusual and a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going, he said. Oh, God. He's taking the credit for that, which of course they do. They're reactionary to the numbers, inflation and jobs numbers, and of course they're taking the credit because they're using their tools. But more or less, the tools, do have a lagging effect. So raising interest rates does kick in a bit later on. Doesn't happen straight away. Doesn't affect the banks and the loan market straight away, but it does kick in slowly and gradually. But it's more they're talking. They talk up the markets. They talk their way to achieving what they want to achieve. So it's more or less jawboning, and they just do so much of it, and they lie a lot to give you a false premise on what they think, how confident they are. They've got to sound confident. They're doing their job properly. Because if they sound really negative and we're behind, we've got a long way to go, then that's going to be obviously bad for the markets, bad for their job. Their job role is to lie, to jawbone, and to react once what the data tells them to do. So they're always behind the curve. They're reactionary, but the talking they do, the jawboning is before. It's getting everyone excited, everyone optimistic, everyone confident the Fed's doing their job properly, essentially. Yeah. So anyway, so stock surge, right? So you're talking about that in the market. So stock surge on this news, especially the small cap stocks, did quite well. And you got the Dow Jones up 1.12%, S&P up 2%, and the Nasdaq 3% at the high of the day. So the markets really liked what he said, as he was talking very dovish. Fed will evaluate inflation and employment with closer to equal weight, as Powell says. When we are far away from our inflation mandate, we had to focus on that, Powell said. Now we're back to closer than even focus. So they're now focusing on both. Inflation was their really main focus. Now that's under control. Seeing it each close to 2% target. It's at 3%, so it's slightly above CPI. And PCE is at 2.5%, so they're nearly there. So they're now looking in both now. They're concentrating more on the job market because inflation is really under control in their eyes. And it's normalised, okay? So job market gradually normalised from overheated conditions. I don't believe that, but that's what they believe. The Fed rate cut could be on the table in September if inflation test is met, Powell says. The broad sense of the community is that the economy is moving closer to the point at which it's appropriate to reduce our policy rate. The question will be whether the totality of the data, evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labour market. Powell says, if the test is met A reduction in a policy rate could be on the table for as soon as next meeting in September. So very, very dovish. Second quarter inflation data has added to our confidence. So as the data comes in lower and beats expectations, they're becoming more and more confident that their tools and they're talking at the market, and everything they're doing at the moment to keep the markets happy. They're talking and to use their tools effectively to actually bring the numbers down. That they're on track to cutting rates. So they're attending to both sides of the dual mandates, the jobs market and the labour and inflation. So they're saying the labour market has cooled and inflation has declined. The risk to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attending to the risks of both sides of our dual mandate. There's not much to say there. And yeah, it's a lot, pretty much what he's going over. And then we have the 10-year Treasury yield, okay, which did dip a fair bit. Ahead of the Federal Reserve's July rate decision, the yield on the 10-year Treasury note slid to about 4.11%. Its lowest level since March 12, when it was at 4.081%. Though that is just a 3 basis point decline on the day. It is far cry from last October, when the benchmark touched 5%. First since 2007. The 2-year yield also hovered around 4.36, little unchanged day. So the 2 years are still above the 10-year yield, which is still inverted, and the 10-year fell a bit more than the 2-year on the news. So the inversion still stays, remained the same until we get the 2-year really, really drop and 10-year not dropping as much, and then we'll see, cuts pretty much. That's the Fed really control the 2-year yield a lot more than I do on the 10-year. They don't affect it as much. But we need to normalise rates on the treasuries to see, eventually when it does, when it uninverts and it comes below the zero line and the 10 years pay more than 2 years, recession will come. And yeah, that's just inevitable to happen. But that's just going over the yield, treasury yield market. The S&P's reaction to that, Microsoft was down 1%, which is quite odd. Everything else is up. Amazon, NVIDIA had a huge, I'll talk about NVIDIA coming up. 13%, massive day for NVIDIA, absolutely huge. Google up, Apple, Meta, Amazon, Tesla. It's a Magnificent Seven really cleaning up today on the news, or the previous session, I should say. And some sectors are down, but the Mag 7 generally is up. Crypto market, bad. All negative except for very few. Barely 1% up there, barely 1% up there. And you can't even read these ones, but yeah, all negative. The top ones looking terrible. Bitcoin down 2.5%. So not good day for the crypto market. We had Meta earnings come out. It's soared over 8% after beating Q2 2024 earnings expectations. Meta reported Q2 2024 EPS of $5.16, above expectations of 5.72. Am I reading that right? No. I have to double check that one. But revenue of $39.1 billion, expectations of 38.3. I think they're just saying they come in at 5.72, above 5.16. So beating that number. I got the mixed the wrong way around. They're also reporting that they have 3.27 billion daily active users, above expectations. And yeah, this big God candle, this huge, massive candle they got to call it. It's quite big, so it did well on the news. But really, it's to do with the economy, the Fed's dovish talks, and the whole stock market pretty much did quite well. The overall indexes, as I mentioned previously, and this added to the, the good dovish talk with the Fed, and yeah, just going along with the market. and good to see that they're beating earnings. Nvidia has added 330 billion in market cap today, the largest single day gain of market cap in any stock in history. This includes the current after-hours move. Nvidia has added 390 billion today. So the biggest single adding of market cap in history just occurred, Nvidia, which is quite staggering, amazing, really credible. And one person that really got ahead of this move and did quite well on this massive 12% gain a day was no other than Nancy Pelosi, of course. She bought the dip in Nvidia and sold Microsoft just before their earnings plunged, the greatest trade of our generation. So you can see the periodic transaction report, and on the 26th of the 7th, she sold, Microsoft. So she sold Microsoft there about a week ago, and she paid a couple of gains, of course, which you'd hope so, now that she's not a politician. She sold 5,000 shares, all right, so it was about $1 to $5 million she sold. And at the same time, same day, 26th of the 7th, she bought a heap of Nvidia stock, which is around the same, $1 to $5 million, and she bought 10,000 shares. So she's doing really well on her trade, selling a loser before it was a loser and buying a pre-winner. And that was Nvidia. So she, insider again, cleaning up. And we'll go to the savings rates. The US personal saving rate declined from 3.5% in May to 3.4% in June, the lowest since December 2022. By comparison, May 2023, the savings rate was 5.3%. Excluding 2022, the savings rate sits at its lowest level since 2008 financial crisis. This comes under US households depleting over 2.3 trillion of excess savings since 2021. At the same time, the credit card debt reached 1.06 trillion in July, just 3 billion short all-time record. Savings is now considered a luxury. That's the chart there. The savings rate during the pandemic had a huge spike up, 30%, 25%, because of all excess stimulus money the government was giving people, so they had extra savings. It was good. And then the fight against inflation, and the decline of markets, and then the savings rates dropped dramatically from these big peaks. So now we're hovering at lows. If you get rid of this data here, we're the lowest level since 2008 financial crisis, which is very bad. People don't have extra disposable income, and they're really struggling. And it's not the good economy that Powell says it is. Stronger than expected, because people are really feeling that their savings aren't quite there, as inflation still persists and goods and services still high, despite the what the Fed say. It's really what the reality of the consumer is what matters in the end of the day, and the consumer, lower income people, aren't feeling it. They aren't seeing inflation come down. They're seeing it sitting, which there's certain sectors that have come down, certain ones that haven't. And, and it just shows on this chart there. Very bad. So coming up, tomorrow, we have Apple and Amazon earnings. It's good to see if we do come in better than expected, EPS and revenue numbers, or they decline and miss. But that's the earnings coming up for tonight's session. So that's earnings coming up. And then on the next day, we have Berkshire Hathaway, as notable earnings. And that's it for the stock market and the rest of the markets. All right, guys, I hope you enjoyed that one. It's going over what the Fed said. They kept the interest rates the same. I wasn't surprised. Talking very dovish, as expected, because they're really proud of their progress. And they see that inflation is coming down towards 2% quite considerably, and the unemployment rate remains historically low, which is quite true. But if you start getting in the high fours, we're in trouble. I see it personally, but at the moment we're still below recessionary levels. And then looked at earnings for Meta coming better than expected. Nvidia had its largest gains while the whole stock market did quite well, Microsoft was down 1%, and crypto market did really terribly, actually, after the Fed press conference. And looking at savings rate of the US consumer, and then looking at ADP numbers as well, seeing that the jobs added are declining, which is not good for the jobs market. We've got to see at end of Friday to see if the unemployment rate goes up, because that'd be really, really, if it's above 4.2% or above, recession. We're in a recession. The SARM rule will be triggered. If it stays the same, 4.1, or goes lower, then we're not in recession yet. So to hold off there. But so far, stocks liked it. Crypto market didn't. But yeah, we have to go with the data as the Fed do and take it month by month and evaluate, and then just wait for our strategies to, if you've got a strategy to enter the market, you got to wait for it to trigger. Mine hasn't triggered yet. I'm waiting for a big decline in the markets. Hasn't happened. Still euphoric. Still looking good. And in the meantime, we just sit on our hands and wait for the opportunity to buy. But yeah, I showed you Access Savings. It's just no one's got the money to invest in the markets. Like 3% savings rates is horrible. It's basically, if you take out 2022 numbers, go back to 2008 is the last time we had a low savings rate. So it shows that the consumer doesn't have the money to invest in the markets. There's only got enough money to put the food on the table, for their everyday expenses, pay their bills, not money to put in the markets. So the consumers, everyday person, aren't participating in this market. It just shows that. I mean, there might be some people, their retirement obviously counts and all that, but the active investors, doesn't show that the retail is involved. It's just mainly institutionals and the big hedge funds, and that are really benefiting off this stock market rise. It's not everyone else is suffering. So it's the buying power of the average individual, as the inflation really hurts people. And yeah, that's it for the video. I want you to smash the like, comment your thoughts below, subscribe to stay updated, and I'll catch you in the next one. Cheers.